BEPS proposals being discussed at the OECD generally are not limited to the so-called digital economy. In fact, labeling the discussions as work on the digital economy is somewhat misleading at this point. While many of the unilateral measures that spurred the work are targeted at certain digital business models, the work at the OECD is really focused on two different issues. The first, referred to as Pillar 1, is focused on increasing the amount of profit allocated to jurisdictions where customers or users are located. One of the proposals in Pillar 1 would be limited to certain digital business models, but the overall direction of the work seems to be toward a proposal that would apply to all businesses. Pillar 2 of the OECD work, on the other hand, is focused on remaining BEPS risks and would impose two minimum tax provisions. The first would be a minimum tax on Cfc income, possibly with some similarity to the US GILTI provisions. The second would be a tax on cross-border payments if the recipient is not subject to a sufficient level of tax on the payment. These proposals also are not limited to the digital economy, but would apply to all businesses. The BEPS recommendations were focused primarily on addressing so-called stateless income, while the current discussions, especially Pillar 1, are much more focused on changing the allocation of taxing rights between source and residence countries. Of course, there is overlap between the two projects. BEPS included changes to the transfer pricing rules and an expansion of the PE standard that applies regardless of whether there is stateless income. And the new work includes proposals for minimum taxes to address BEPS concerns. Overall, though, the new work is much more focused on changing the allocation of taxing rights than the BEPS project was. The proposals under Pillar 2 are somewhat similar to some of the changes that were enacted as part of US tax reform. Specifically, the minimum tax on Cfc income may be similar to the US GILTI provisions in that it would apply broadly to all types of Cfc income, and not just certain types of passive or mobile income. It may also include an adjustment similar to the Q-buy concept in GILTI, which provides an exemption for a deemed return on tangible assets, though they are also looking at other ways to target supernormal returns. On the other hand, there may be significant differences between the proposal at the OECD and the US GILTI provisions. For example, the US GILTI inclusion is computed based on a worldwide aggregation of Cfc income, while the proposal at the OECD currently appears to favor a country-by-country approach. The proposal at the OECD also may not include the complicated foreign tax credit provisions that apply to GILTI in the US. Some people have also compared the minimum tax on cross-border payments to the US BEAT, though I think that comparison is a bit strained. In concept, the minimum tax on cross-border payments tries to address the same problem as the BEAT, base eroding payments, but the basic design is very different. The minimum tax would deny deductions or impose withholding tax on payments if the recipient is not subject to a sufficient level of tax. The BEAT, on the other hand, only partially disallows deductions related to certain cross-border payments, but it also denies credits, and it generally doesn't care whether the recipient of the payment is subject to a sufficient level of tax.